Hello, welcome listeners and market participants, and welcome to KBRA's European Credit Podcast, Conversations in European Credit. I am Gordon Kerr, Head of European Research at KBRA, and today I am joined by my colleague Yee Cent Wong, our co-head of Europe here at KBRA.
Hello, everyone.
Today we will be covering the topic of commercial real estate exposure in covered bonds in Europe. A report on the topic titled Commercial Real Estate in European Covered Bonds can be found on kbra.com, along with a number of related publications such as our European Structured Finance Outlook and one covering the topic of refinancing challenges in commercial real estate. Jump online and have a read. European commercial real estate has been challenged over the past several years with rising interest rates and pandemic-driven remote work trends. As interest rates remain high and refinancing comes due, the sector will remain challenged in 2024. One source of funding for the commercial real estate market in Europe is via banks and mortgage lenders and their issuance of covered bonds. Covered bond exposures to commercial real estate vary based on jurisdiction and lenders. Most mortgage covered pools mainly contain residential mortgage loans, but commercial mortgages can be found in a number of issuer covered pools, as you will hear about. All right, Yee, let's get to it. The topic of commercial real estate challenges in Europe have come to the fore recently. But first, let's give our listeners a bit of background on covered bonds. What are they, and why is this topic relevant?
Thank you, Gordon. Covered bonds are dual recourse instruments issued by financial institutions. First, there is a recourse to the issuer, followed by a recourse to a designated pool of collateral. While the issuer is performing and continuing to pay under the terms of the covered bonds, investors will not have exposure to the covered pool. Keep in mind that a majority of the covered bond issuers in Europe are rated investment grade, with many of them in the high investment grade category. In terms of the covered pool itself, legislation differs from country to country as to what can be included as collateral. The most common collateral for covered bonds is mortgages, with the majority of these residential. However, what we have focused on in the recently published report is the commercial real estate exposure within the pools, which in some cases can be substantial. As mentioned earlier, although investors are only exposed to the covered pool if the issuer fails to perform, we thought it would nevertheless be interesting to look into the commercial real estate exposure, given the headwinds in this sector. Gordon, you did some work in digging into the data. What have you seen with regards to the makeup in covered pools?
Yeah, thanks, Yee. As you highlighted, covered bond programs can contain varying types of collateral. This can range from shipping loans to mortgages. The area of our focus is on the largest segment of the covered bond market, the dedicated mortgage pools. Now, these typically contain either purely residential mortgage loans or a mix of residential mortgage lending and loans secured by commercial property. While nearly every European issuer can include commercial mortgages in a covered pool, in practice, they are not generally included in covered pools. Out of the 26 European countries that do participate in the covered bond market, only 10 have issuers with commercial mortgages in their covered pools, including the multifamily lending mainly found in Finnish and Norwegian covered pools. Multifamily commercial lending also exists within German and Austrian covered pools, but we have excluded these and focused on strictly commercial use lending in the report.
All right, so what do we see in terms of those countries with commercial real estate, excluding multifamily?
Okay, so there are only 8 countries that have commercial real estate exposure in their covered pools. The largest volumes of commercial mortgages are found in German Pfandbrief, where 30 covered pools contain commercial mortgages with a grand total of 129 billion euros in loans. This equates to an average commercial mortgage proportion of 38% of the covered pool, and a range of 1 to 93%, depending upon the issuer. Of the 30 covered pools issued out of Germany with commercial real estate exposure, 11 have covered pools with more than 50% in commercial real estate lending. In the second largest market, Denmark, only 2 of the 9 pools looked at have exposure greater than 50%. Denmark itself has 91 billion euros of commercial lending, and an average proportion of only 21%. This is followed by Austria with 42 billion euros and an average proportion of around 31%. In Austria, only 9 out of the 19 pools have a proportion of commercial real estate greater than 50% of the covered pool. None of the other countries have cover pools with more than 50% dedicated to commercial mortgage lending.
Interesting. I assume most covered bond issuers tend to stick within their home country for commercial real estate lending.
Yes, the main exceptions to this are Germany and Austria, where lending is done across the globe. Issuers have exposure to both euro area and non-euro area. However, the vast majority of commercial real estate lending in cover pools is to within Europe, and over half of that is within the euro area. So in total, there is 309 billion euros in commercial real estate lending across the 8 issuer countries. 186 billion of this is in Eurozone countries. 111 billion is lent within European but non-Eurozone countries, and the remaining 12 billion euros is lent within other OECD countries, mainly the US.
What about within the Eurozone area? Which countries have the most commercial real estate and cover pools?
Covered bond issuers have the greatest exposure to Germany and Denmark, with the majority of that lending originating from their respective countries. There are 82 billion euros of German mortgages in cover pools, with 78 billion of this lending from German lenders. In Denmark, the total is 81 billion, with virtually all of this from financial institutions within the country. The next largest exposures in the covered bond market are Austria with 37 billion euros of borrowing, and Spain with 32 billion. Sweden has 17 billion and France with 11 billion, and the other countries are of much smaller proportion.
Okay, so there appears to be a considerable amount of commercial real estate lending from within some countries, but to what extent is this lending to smaller properties versus larger ones? Did you manage to dig up any information on the size of the loans?
Yes, it took a bit of work, but overall average balances of commercial loans and cover pools varies across the different countries. The average loan size is quite small in places like Sweden, Italy, and Spain, ranging from an average of 100,000 euros in Sweden to 240,000 euros in Spain. In the other regions, average balances are a step higher. In the larger countries for commercial collateral, there are a significant proportion of bigger loans in covered pools. We gathered data and calculated an estimated volume of loans over 10 million euros in size amongst the commercial lending in covered pools. In total, just under one half of the commercial mortgage lending volumes overall are of this size, with a total of 146 billion euros. Germany is by far the largest proportion of this size lending, with 94.5 billion. For the other countries, Denmark is the next largest with an estimated 26 billion, followed by Austria with 16 billion of lending of this size. For the remaining countries, the total lending over 10 million is relatively small.
What about sector exposure? Commercial real estate itself contains varying types of properties, such as offices, industrial, and retail. Where does most of this collateral fall in terms of classification and cover pools across Europe?
In the report, we go into it in greater detail, but the majority of mortgage lending largely falls under the category of offices, retail, agriculture, or industrial. Office and retail alone account for over 50% of mortgage lending. Offices are the largest exposure, with 107 billion euros lent to this segment. This has been a significant area of interest recently. And maybe just flipping it back to you with your background in commercial real estate, maybe you can outline KBRA's views for this segment to our listeners.
Yeah, sure. From what we have observed, vacancy rates for office properties have generally been trending upwards since 2020 due to pandemic-related remote work trends. As a result of rate rises and a challenging environment, yields have also been increasing since the second half of 2022, generally reversing 10 years of declines. It's been about 2 years now since most major companies have called for a return to the office, but employees have largely returned on a hybrid schedule, signaling that some level of remote work is here to stay. Tenants have been reducing their footprint or expanding more slowly, signing shorter leases as they figure out longer-term space requirements. As a result, this segment of the market is likely to remain an area to monitor in 2024.
That is interesting. What about the next largest segment of the market, the retail sector? Here, there is 59 billion euros of exposure in cover pools. This is spread across most issuer countries, but the largest concentrations fall within Germany, Denmark, Austria, and Spain.
Consumer spending has been declining with the rise of inflation, thereby impacting retail sales. This may cause some retail properties to struggle, especially those tenanted by stores that rely heavily on discretionary spending. Additionally, e-commerce sales remain on a long-term trajectory of taking a greater share of total retail sales, which will continue to put pressure on brick-and-mortar retail assets. While both of these sectors do face a challenging environment, the covered bond structures do offer protection.
Yes, covered bond frameworks set out loan to value or LTV limits and ongoing valuation requirements that aim to limit credit risks in mortgage covered pools. Broadly speaking, almost all countries have an LTV cap of 60% for commercial mortgages. A number of countries do allow this to rise to 70% so long as additional over-collateralization is held in the pool. Average LTVs for commercial loans across the pools range from 34% in Italy to 54% in Germany. The valuations for these calculations are done in what is referred to as a mortgage lending value, which is typically lower than market values. In Germany, Austria, and Spain, Austria has an average LTV of 49% on this basis, and Spain an average LTV of 38%. The others, Czechia, France, Denmark, Italy, and Sweden, utilize a market value basis. Czechia has the highest stated commercial lending LTVs with 52%, followed by France with 46%, and the rest much lower.
You mentioned over collateralization. This is also a measure of protection in covered pools?
Yes, a key factor in maintaining the security of a covered bond is the over collateralization of the pool. This measures the extent to which the loans and other assets within the covered pool exceed the outstanding covered bonds. As covered pools contain both residential and commercial mortgages, the level of over collateralization will vary depending on the mix of the covered pool and at the option of the issuer. Regulations do dictate a minimum level of over collateralization. This has been outlined to a varying degree within a number of countries. For the countries we have focused on, where commercial lending is included in cover pools, the average over collateralization is 35%. This offers a meaningful degree of protection should an issuer default occur and investors be required to rely on the cash flows from a cover pool. Anyway, you can find more in the report online. Thank you very much, Yee. That was very insightful.
No problem. It was a pleasure.
As we outlined in our conversation, commercial real estate is included within cover pools in only a few select countries in Europe, despite the availability of the option available to nearly all issuers. Germany, Austria, and Denmark dominate the inclusion of commercial mortgages. A large exposure to office and retail properties could present challenges as these sectors continue to face headwinds. However, as outlined, the dual recourse nature of covered bonds, over-collateralization, LTV caps, and the use of valuations that are typically lower than market values in certain jurisdictions provide a positive backdrop to support the challenges ahead. That's it from us today. As always, we hope these conversations in credit help to illuminate the many trends taking shape across the markets. For more in-depth coverage on the themes discussed today, or to learn more about our unique approach to credit, sign up to the KBRA website to read all our research. Have a topic idea or comment you'd like to share? Reach out to me or one of our KBRA analysts. Be sure to subscribe to the podcast so you can be notified when new content is available. Invite your colleagues as well. We'd love to count you all as informed listeners. This is Gordon Kerr, thanking you for being part of the conversation. Take care, everyone.